Hello and welcome. I'm Saeed from storyplanet.net. Dive right into the essence of the most captivating books without reading them cover to cover. Whether you're on the go, at the gym, or just relaxing at home, we offer you a unique and enriching listening experience. Today, we are exploring the book, The FALCON Method, a creation by David Solyomi. The FALCON Method, 2017, provides a clear, data-driven investment strategy ideal for everyday investors. It assesses various assets accurately to identify prime opportunities, relying on trustworthy financial signals and a systematic approach that mitigates emotional influences. Before we delve into these revelations, it's interesting to note that after being CEO of multiple companies, David Solyomi stepped down at 33 to become a full-time investor. As an educator and investor now, he shares the wealth-building strategies that led to his success, aiming to guide others to financial freedom. With 8 key ideas to unveil, brace yourself for a deep dive into this captivating book. On storyplanet.net. To start, the text suggests a reliable investment method that offers benefits to the individual. The FALCON Method focuses on investing in company shares to achieve financial independence. It provides objective measurements to evaluate businesses and identify promising investment opportunities. Stocks are highlighted as a key asset class, and guidance is given on navigating the investment landscape wisely. Key idea number 1. Stocks are considered superior to other types of investments. Warren Buffett, a renowned investor, categorizes assets into currency-based, unproductive, and productive. Currency-based investments, like bonds, may be affected by inflation. Unproductive assets, such as commodities, provide no income. Productive assets, like company shares, offer long-term income and potential growth through ownership in a business, dividends, and market value. Buffett recommends productive assets, like shares, for wealth building. Key idea number 2. Understanding cash flow generation and utilization is essential for successful share investment. To invest prudently, understanding how companies operate is crucial. A black box metaphor by David Van Knapp highlights the importance of analyzing input and output pipes of a firm. Input pipes include revenue and equity sales, while output pipes include expenses, acquisitions, and profits. Profits are especially important as they can reveal a company's investment potential through dividends, share buybacks, and retained earnings. The metaphor encourages focusing on visible aspects of a company for better analysis and decision-making. Key idea number 3. The FALCON Method suggests a buy and hold strategy for investment success. The text discusses the differences between the classic quant investing method and the FALCON Method. The classic quant method involves ranking stocks based on quantitative criteria and holding them for a year before selling, while the FALCON Method emphasizes a buy and hold strategy with a focus on long-term investments in reputable companies. The FALCON Method aims to limit emotional decision-making and biases by only selecting stocks that pass rigorous filtering, leading to above-average investment opportunities. Key idea number 4. The FALCON Method starts with selecting high-quality companies. The FALCON Method advocates investing in well-known companies with a history of paying dividends for at least 20 years without reduction. Dividends are seen as reliable indicators of a company's financial health, unlike other financial figures that can be manipulated. Companies with consistent dividend payments show strong earning power and tend to perform better. The method differs from solely focusing on the S&P 500's dividend aristocrats, as it seeks opportunities beyond those firms and values long-term dividend history without reduction. While a good dividend record doesn't guarantee a great investment, it is viewed as a positive indicator for investors. Key idea number 5. FALCON Method's second step involves identifying stocks that are undervalued and can be purchased at a low price. The key to getting a great deal on investments is to recognize that the market price of a company fluctuates daily, but its underlying value remains constant. Purchasing shares in solid companies when prices are low relative to their historical average can lead to profits, as market prices are influenced by human behavior and emotions. By going against market trends and opting for quality companies during pessimistic times, investors can capitalize on discounted prices. Conversely, it's unwise to invest in companies at overinflated prices during times of euphoria. Key idea number 6. Third step of FALCON Method. Develop dependable filters to further analyze chosen stocks. The FALCON Method uses 3 main financial indicators: dividend yield, free cash flow yield, and shareholder yield to filter potential investments. Dividend yield compares dividend payout to stock price. Free cash flow yield measures leftover cash after operational costs, and shareholder yield combines dividends and share buybacks. Setting minimum values for these indicators can help filter out potential investments, but it's important not to set the thresholds too high. Key idea number 7. Step 4 of the FALCON Method involves ranking the survivors. The FALCON Method uses weighted multi-factor ranking to identify and rank top stocks based on various factors. An example highlights equal weighting of dividend yield, free cash flow yield, and shareholder yield for stock A and stock B. New metrics, like a modified Chowder rule, are suggested to evaluate future growth potential. The method recommends constructing multiple Chowder rules with different timeframes for a more comprehensive analysis. Key idea number 8. FALCON Method's 5th step is to use your own judgment. The FALCON Method prioritizes quantitative indicators to avoid bias. Subjective judgment can be useful in final selection rounds, focusing on ROIC for monitoring a firm's capital efficiency. Avoid cyclical stocks for consistent growth, as they pose extra risk due to volatile price fluctuations. The method emphasizes structured rules and financial indicators for selecting top investment opportunities, aiming for steady long-term growth. In conclusion, the FALCON Method advocates a precise investment strategy focusing on rigorous company evaluation and long-term dividend payers. Actionable advice includes analyzing companies and building a list of long-term dividend payers. Millennials, who are typically risk-averse despite their access to advanced tools like the FALCON Method, can benefit from learning about investing in stocks from sources like Millennial Money by Patrick O'Shaughnessy. Thank you for listening to this summary. If you enjoyed this exploration, we invite you to discover other fascinating books on storyplanet.net. Don't wait any longer. A multitude of books, stories, and knowledge await you there. See you soon on storyplanet.net.